Hi, my name's Leah Parrino, and this week's learning module is about finance and investment. There are 3 learning objectives for this presentation. The first is to list the key types of financial statements and explain why the information provided in these statements is important. The second is to explain what the time value of money is and why it's important. And the third is to discuss the difference between diversifiable risk and market risk and how each influences investors. One of the key financial statements is the balance sheet. The balance sheet shows the company's current financial position at an exact moment in time and shows the company's assets, liabilities, and equity. Assets include items such as cash, land, property, equipment, and other items of value. Liabilities are obligations that will be settled by using these assets, and the equity is what is left once you subtract liabilities from assets. In equation form, this can be calculated using assets equals liability plus equity. The balance sheet example on the right shows that each side of the statement ends up totaling the same number, making it balanced. Another key financial statement is the income statement. The income statement, unlike the balance sheet, is for a specific period of time. This could be a month, a quarter, or a whole year. Income statements are important because they show the company's profits and losses, resulting in the company's net income. The statement is used to determine a performance benchmark among companies so that it's easier to compare results amongst competitors. The last statement is the statement of cash flows. This can be over any period of time, just like the income statement. The cash flow statement tells you a company's sources and uses of cash during a period. This includes cash flow from sales, inventories, buying and selling equipment, or any other cash transactions. The next topic is the time value of money, which refers to the fact that the present value of money is worth more than that same dollar amount of money would be worth in the future. This means that if you had $1 today, it would be worth more than that dollar would be worth in the future because of the money's potential to grow in value over time. For example, you'd rather get the $1 today and put it into an account so that it can grow over time than get that dollar in 10 years and have lost the 10 years that you had as an opportunity to grow the money. This is the equation for calculating the time value of money. It may look a little complicated, but it is simple once broken down, where FV equals the future value, PV equals the present value, I is the interest rate, N equals the number of compounding periods per year, and T equals the number of years. For example, if $10,000 today were invested for 1 year at a 10% interest rate, the future value would be $11,000. This shows that if you were given the option to receive $10,000 today or $10,000 in 1 year, it's more valuable to take that money now and let it grow. The next topic is diversifiable risk versus market risk. And diversifiable risk is also known as unsystemic risk, and this is the risk that is specific to a particular company or an industry. The risk can be lessened by diversifying your portfolio with investments from other companies or industries. Market risk, on the other hand, can't be eliminated by diversification. Market risk is when an investor experiences a loss because of the market's overall performance. Examples of events that can impact the overall market include a recession, political changes, or interest rate changes. The following are supplemental materials that can help better explain the topics that have been discussed. The first 3 videos are good explanations for each of the 3 financial statements that we talked about. These first 3 videos do a very good job at clarifying and visualizing each of these statements. The next resource is an article that gives real-life examples of how the time value of money works and demonstrates how relevant this concept is. And the last article explains the importance of diversifying your investments to eliminate bringing more risk into your portfolio than is needed. And the discussion questions for this module are: what are the key types of financial statements and why is the information in these statements important? What is the time value of money and why is it important? And the last is, what is the difference between diversifiable risk and market risk? The following are resources that were used in the information in this slideshow.